Should you hold equity forever? What we've seen over the years of managing equity portfolios is that a lot of analysis and a lot of reading goes into equity purchases, whether you're buying an equity mutual fund, whether you're buying a portfolio management service offering equity, or whether you're buying direct stock. But when the time comes to sell, there somehow seems to be some sort of loyalty which gets created to either the fund manager or the scheme or the individual stock. And there is great hesitation in terms of making an exit, even though all the signals may be indicating that this is a time for us to say bye-bye to that particular investment. Additionally, there are also other emotions that take over, greed and fear being the two most common. And therefore, it's very important for us to be able to separate out the logic of why we are doing an exit decision when we choose to make an exit decision. There are 5 pointers that we'd like to give you to help you decide better and act quickly when it may be the right time to make certain exit decisions in your portfolio. Number 1, rebalancing is critical. What tends to happen when equities go up is that your strategic asset allocation may change. For example, if your strategic asset allocation is 50% growth assets and 50% defensive assets, it may move to becoming 60% growth assets and 40% defensive assets. It is therefore very important for you to rebalance back by selling some equity and moving into defensive assets, even though all the noise around you might tell you exactly the opposite, saying, why don't you make your equity, for example, 70%? Number 2, valuations matter. We need to be able to differentiate between valuations and price. These two often get confused, and therefore when a Nifty, for example, is at 20,000, a lot of people wonder whether it is too expensive, too cheap, moderately priced, whatever. The right way to look at this is to think about valuation parameters. For example, price to earnings ratio, price to book ratio, EV to EBITDA, etc. For example, if you look at Nifty 50 valuations today, even though the price may be 20,000, the valuations are at about 22.5 times forward, which essentially means that you're about 1 standard deviation above mean, which probably reduces your margin of safety in investing in equity pretty significantly. Number 3, remember your goals are very, very critical to keep in mind. For example, if you need money for an education 5 years from today, let's say that amount is 50 lakh rupees. One of the things that can happen when equities do well is to actually ride that wave and say, okay, let that 50 become 60 or 65 or 70 or whatever else. And therefore I can take advantage of the situation. But in these kind of situations, you don't want a market correction to actually prevent you from achieving the goal that you worked so hard in achieving. So therefore, try to bring down the risk in your portfolio as you get closer to goals, rather than keeping it where it was or increasing it. It's always better to be safe than sorry when you're planning for financial goals. Number 4, fund manager or fund schemes can create biases. So we need to be aware of some of these biases that tend to exist. For example, we could believe someone's a really good manager and therefore want our money to be invested there. And when the manager leaves, it can put us into a dilemma in terms of what should be done. Should I exit the scheme right away? Should I stop my further investments? Should I buy more? What exactly should I do? And this becomes even more complex when you have a great pedigree of a fund house on top of it. Our suggestion during these phases is to pause a little bit. Watch who the new fund manager is, watch what the person's doing, give it a little bit of time, let's see how the performance plays out. And then if that warrants a change to be done, one goes ahead and does it. One should not be falling in love with just a fund house or a fund manager when you're making an investment choice. The same holds true even for stocks, because what tends to happen is we tend to fall in love with the stocks that we own, especially those where we work in those same companies, and therefore there can be large concentration risk that accumulates because our salary and our stock options could be coming from the same place, and therefore any downturn could impact both. Number 5, underperforming funds or stocks need to be weeded out. It's very important to understand that in a portfolio there are bound to be things that will underperform, and as much as we might want to hold them forever, I think it's a great idea to look at that carefully, see where the underperformance is coming from, look at peer comparison, and then make those decisions on exiting when it's the right time. There's no point in continuing to hold them just because you have a loss in your portfolio. All in all, having a good exit strategy is a very, very critical part of investing. And while you have to be mindful of taxes and exit loads when you're making those choices, do not allow these to override everything that you have. Do you live after marriage happily ever after? Probably. Should you be doing the same with your equity investments? Probably not. So keep track of them.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BUSL and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory.